Welcome to Hornet and Roberts' video, AIFMD, the latest interpretations and rulings. We were pleased to partner with Grant Lee, Director from PwC. As with all live recordings, there is a little bit of background noise, so apologies for that. And also, please ignore the slide numbers that Grant says. Due to the fact he skipped in a few places, we had to realign that for the video. We hope you enjoy.
I guess AIFMD really has been kicking around quite a long time, and bear with me if this is at a really basic level to start with. I thought what I'd do is sort of go through, again, just a refresher in terms of AIFMD, what it means, and I guess the bare bones really in terms of impacts for asset managers. But actually what I'd like to focus on is, okay, well, AIFMD's landed, we're there. We've been through authorization, we're sort of living and breathing it at the moment, so what does it mean from an operational perspective? As well as, I think there's quite an interesting dynamic around distribution, and actually how US managers are thinking about entering Europe, accessing markets in Europe, as well as, I guess, European and specifically managers who historically might have been based in Guernsey and Jersey, and how they're sort of thinking about marketing going forwards. As well as that, whilst AIFMD, from a large perspective, I guess being through the authorization part, there is more to come. So I thought I'd spend sort of 5 minutes at the end thinking about, well, okay, we've been through authorization. What else do we need to worry about from I guess from an operational perspective, but also from a asset manager, a general asset management perspective. So going on to slide 3, just a reminder really in terms of where we are on the timeline. So when Level 1 came out, which Level 1's law, the European Commission issues law into European law. That again transposed into national jurisdictions, and so this came into UK law in 2011, with more to come in 2013. So from a UK law perspective, it's in there. We have to comply. But actually there are various timelines around. So there was a transition period from July 2013 to July 2014. We've been through that. The next milestone is ESMA having a look at, from a non-European perspective, actually how do we need to change this? Do we need to open up the passport to non-European managers? So we're expecting something sort of mid-next year around that from ESMA. Considering we haven't had a CP yet, which is a consultation paper, actually it's not leaving him a lot of time to get something out sort of mid-next year. So we expect the timeline possibly to go back a bit on that, perhaps late next year. And then the next thing is really looking at the sort of private placement regime. The private placement regime has changed slightly from what it used to be, i.e. the status quo. And now it's the sort of PPR, which does have AIFMD impacts in there. And actually, I've been speaking to some clients across the pond who have missed some of the reporting deadlines on that. So we can touch on that as well. Just what does private placement regime mean, and what are the things to look out for? And that milestone is 2018. So we've got, sitting here until July 2014, we've got another 4 years really for this whole thing to live its course. And really the way to think about it is European managers, non-European managers, European AIFs, non-European AIFs, managing and marketing. So those are the ways that you sort of get caught in this thing. So to slide 4, just touching quickly, I guess, in terms of some of the high-level impacts. And the way I think about this really is in a couple of ways. One is, what are the impacts from a manager perspective, and what are the impacts from a fund perspective? So if we think about the manager and actually what are the activities the manager covers, performs, etc. And there are a couple of ways of looking at this. One is the key functions of portfolio management and risk management, and actually also what's in the manager's gift in order to delegate. So if you have a manager agreement, actually what activities does that cover? And therefore what's in the manager's gift to delegate? And by delegation, we're really talking about core activities, and there's something in the level 1, which is Annex 1, which really talks about all the activities from a regulatory perspective that a manager can undertake, and which ones are those sort of covered by delegation. But primarily in the UK, the way the FCA thinks about it is what's in the agreement, and therefore what's in the gift of the manager to delegate to another party. And we've talked about this also, you've got to watch out to be part of a big institution. Are you delegating things across different territories? So typically in a big financial institution, you may get a service company. That service company could have all the PMs, all the staff, etc. Is there a formal delegation between the AIFM, which is the manager, and that service company? And it's just worth thinking about from a paperwork agreement, etc. point of view. The second thing is depository. So that's really at the fund level. Depository is certainly in the alternative space, something new. And by scope, this is basically non-UCITS products are covered by this. There are some exceptions on the fringes, but this is a regulation which was primarily written for hedge funds. If you look at the language of it, if you look at the way that it covers in terms of measures things like leverage, exposure, etc., that's all very much from the hedge fund world perspective. So you're transposing that into private equity and real estate, and some of those basic terms are actually quite hard to cover. So, for example, in leverage real estate, really think about it on a loan-to-value basis, which is a bit like a mortgage on a house. So how much of the value of the asset do you have as a loan, and therefore you often get to sort of percentage 40 to, say, 75, 80%. But actually the hedge fund world, it's very much a case of, well, how much exposure do I have past my net asset value basis? And exposure is very much a case of, so if you think about hedge fund world and the rehypothecation, prime brokers are giving hedge funds more financing to go and buy more assets, and therefore that is exposure because you are buying more assets, then you have got equity from your investors. So you've got exposure there from a regulatory point of view. And there are different milestones around that. So the regulator thinks about this from a substantial leverage point of view, which is basically if your assets are 3 times your NAV value. And that's when you start, from a leverage point of view, start to get on the regulator's radar. Unofficially, I sort of know that the FCA is going to have a lot of people who have leverage 3 times NAV. I mean, they're going to be stacks. Most hedge funds will tick that box. And they've internally got sort of higher bars where they start to really start asking questions. But it's something worth watching, because from a reporting perspective, there are additional fields that you need to report on if you are on that substantial leverage box. So, yeah, potentially a bit more work. Remuneration is a big one. So remuneration, I'll come on to, I guess, the distribution side. But certainly in my conversations with US hedge fund managers, US private equity managers, one of the reasons why people might be holding off from the private placement regime is because of remuneration disclosures. So even though in the US you do not have to apply the policy, because you're not subject to AIFMD, you're just marketing, and you're going through the private placement regime, you still have to disclose remuneration disclosures in the fund annual report that you're marketing. And people are saying, look, in the US, we're not used to doing remuneration disclosures. Actually, I don't want to disclose my pay. I don't want to disclose my fund manager's pay. I don't need to defer their bonus because I'm not subject to that policy. I just don't want to say 20% of my fund manager, because he's got, say, 5 funds, he spends equal time on them, I want to disclose 20% of his pay. I don't want to do that. And therefore I'm going to hold off. Big deal in the UK and Europe. As you probably know, most of the remuneration impacts we expect coming in 2015 because you need a full calendar year at the manager level. And we haven't really had that. So if you've been authorised in July, you haven't had a full year as an AIFM, as an authorised manager. You've only perhaps had a part of the year. Different story if you got authorised in 2013, which you could have done, because you could have become authorised post-July 2013. But actually, for some of the more difficult remuneration aspects, that's not a this year issue, that's a next year issue. But people need to work through those policies now because you need to have the policy up and running before you hit the beginning of that year. And then there's all sorts of disclosure requirements that you need to do once that policy is in place, such as total remuneration, split between senior management, risk takers. Risk takers, broadly speaking, are people who are in a position to change the risk profile of the fund. And there was a question to ESMA, which, okay, I've got an investment committee, I've perhaps an infrastructure fund. Actually, all the big decisions are made at that investment committee. Do I need to disclose the pay of my portfolio manager? And ESMA came back saying, yes, you do, in a Q&A. So, because they could have said, he's got no discretion as to altering the risk profile of the fund. All the big decisions are made at the investment committee. Fortunately, ESMA came back saying, yeah, sorry, fund manager, even if his hands are tied, the pay still needs to be disclosed. And that was a big thing for industry because they were trying to clearly scope as many people out of any of those remuneration disclosures as possible. So that's a big deal. Capital requirements. Basically, a lot of my clients subject to ICAP didn't have too much of an issue here. If you're in a sort of buy Peru 50k type territory, there was a jump. Basically talking, you've got 125k if you're not self-managed, which basically means you've got an external manager, plus 2 basis points on your AUM over 250 million. But that's capped at 10 million, and you have to compare that to a quarter of your fixed overheads. So you can, because of that quarter of the fixed overheads at the manager level, that's a sort of similar sort of FCA UK requirement that's historically been there. Actually, because you're looking at the quarter of your fixed overheads, you can get to quite a big number. So. And often it can be bigger than often, in my experience, it is bigger than the 2 basis points of your AUM, depending obviously on the fund range, fund size, etc. And then you also have to look at professional liability risks, which is, do you have the insurance in place, or do you have the own funds, essentially? Do you have the money from a capital perspective? And they have to be in highly liquid instruments, which again is holding money back at the manager level, which you're going to get a low return on in this environment. So leverage basically talks about the one thing which I guess is a slight kicker is, even if you're holding derivatives from a hedging point of view, that actually ticks the box from a leverage point of view. I was speaking to Olivia Fines, who I think has now left the FCA, or certainly leaving, and there were questions around this because it's actually not clear if you read the directive, but the FCA expectation is, if you have derivatives from a hedging perspective, you do have exposure. Now, there are various ways of calculating leverage, and I won't get into the details now, but happy to talk through them. There's the gross and the commitment method. The commitment method is basically, if you've got derivatives going either way, and it sort of matches the underlying that you're trying to hedge from a risk perspective, actually you can net them down so you get to a lower leverage number. The gross is crazy, because whatever derivative you have, you use the notional value, so suddenly your numbers are sky high. And even if you've got a liability in an asset position, you go back to absolute values. So you're getting to some quite big numbers and actually the AUM, if you look at assets under management, the prime difference between Form PF in the US and this regulation is AUMs calculated on the notional value of the underlying financial instruments. Form PF, in my view, is probably more sensible to mark to market. So, the mark to market basis, it's quite easy to get from an accounting balance sheet number, reconcile that through to what you reported to the regulator. On this, you're going to have some very big reconciliations because not everyone in my experience always has the notional values to hand, so therefore you either got a delta to adjust up in terms of number of contracts plus the delta to gross up, or you're going back to the contracts to actually have a look at the notional value per those contracts. So a big difference. And there's a whole ream of, I guess, derivative conversion methodologies based on the underlying text, which people I know are sort of working through, and especially those more esoteric type strategies where you've got often derivatives based take a while just to work through from a AUM and a leverage perspective. Regulatory reporting, that's a real kicker. I mean, that's really at the fund level, but actually depending on your size, it can be as frequently as quarterly. The first regulatory reporting that you will make, so let's say theoretically your home regulator is the FCA, the first report that you make is the quarter after the quarter you become authorised. So if you became authorised in July of this year, that is theoretically quarter 3, you're reporting on quarter 4 numbers, and you've got a month after that quarter to report. So you got to the end of January to report on the quarter to end of December. If you're fund of funds, you've got another 15 days. That's something like 250 fields, so it's quite a big exercise. And if you're a real estate sort of investment strategy, actually quite a lot of the fields aren't applicable. So if you're a closed-ended fund, it's more of a straightforward exercise. Clearly, if you're a hedge fund with a lot of derivatives, perhaps a more esoteric type strategy, it's more of a difficult exercise, especially going through the notionals. And there's some real kickers there, like turnover. Actually, one of the fields is to report your turnover on a notional basis. Now, I don't know many houses that sort of track turnover or number of trades and the value of number of trades on a notional basis. So that's something just to watch out for. And I think the way that people seem to be approaching it is almost making an assumption. So you say you'll take your daily trades and then you're making an assumption as to a multiplier for each of those type of instruments on that particular day to come to a turnover number. So just a couple of pitfalls really, and some of these, only through working through the detail do you sort of understand where the pitfalls are, unfortunately. Investor disclosures, a lot of this is really around the marketing side, so making sure in the prospectus that you disclose certain things about the fund which are prescribed per AIFMD. And then there's a sort of choice as to whether on an ongoing basis you make some of these disclosures in the annual report or whether you actually do it in the sort of investor reporting. And in my experience, probably about 60% of that has been covered already in good investor reporting. And therefore, I guess there's a smaller delta in terms of the change for investor disclosure. And in my experience, actually, that's one of the areas which probably has the least impact. Acquisition of non-listed companies. Even today, I'm getting questions on this in terms of what does this really mean? Because we've had AIFMD and people have gone through the authorization since July, so we haven't had long where we've been in deal mode on a sort of infrastructure basis, etc. Now, what this means is, if you are buying a large EU listed or unlisted company, essentially you can't asset strip for a period of 2 years following control of that company. And really what that's around is employee protection. So I think a lot of this comes from the sort of Mittelstand in terms of you can't buy a company, strip it out, put it into constituent parts, and employees lose their job. There's actually a period of time before you can do that, and that's locked in for 2 years. Some of the questions we have, which aren't clear from the regulation, are, well, that's fine, but actually does that just apply to the intermediate holdco, or does that apply to the whole group, i.e. all the subsidiaries in the group? And it seems clear that it applies to shares as opposed to shareholder debt. So there's some questions there. Risk management, the big kick on risk management really is, do you have someone, head of risk management, who's independent of portfolio management? And the next question is, are they represented at the board level, and do they have equal authority to the head of portfolio management? So for some, that was quite a big change, because if you'd outsourced that function, actually some of them might have routed through PM, and I worked with a couple of clients where they did portfolio analytics actually as part of the sort of PM function. So some of those moved that sort of portfolio analytics function under risk management, and then we had a proper review stage, I guess, on that sort of on the data being analysed. Clearly, the information is going to come from the front office, but it's just a case of, do we have the right analysis on top of that data coming from the front office in risk management as opposed to portfolio management? And it's all about lines of reporting. So do we have someone, is it reported up on an independent basis as opposed to going through portfolio management? Valuation is really around not only, I guess, the calculation of NAV, which has really seen and historically been a sort of administration function, but really around the valuation of the constituents of that. And is that independent to portfolio management? And really in discussions, this is quite a big deal on the sort of more PE side, where historically you might have had a portfolio manager performing valuations for his own portfolio companies in a fund, and then presenting that to the valuation committee. Some changes around that in terms of actually, have you got independent checks on that valuation? And is the valuation committee independent enough of the portfolio management function? So if you just had perhaps the head of portfolio management and portfolio managers, you may just want to think about, well, if the FCA comes in, actually is that constituent right? And I think most people have got there because you had to describe a lot of the governance arrangements as part of the regulatory business plan when you became authorised. But something just to be aware of now that AIFMD's gone through and become authorised, and now in the sort of operational side, if you like. And then the third country aspects, which really hit sort of marketing, but it's all been around cooperation agreements. Have we had the right cooperation agreements between the regulators in these countries versus the European regulators, etc. And I think on that we've really got there. So I think really just skipping ahead, I'd like to come on to slide 8. And where we've worked with people, I think we've been through AIFMD, a lot of people have become authorised. From a stats perspective, last time I checked with the FCA, there was roughly about 1,000 firms out there, some of which they're still working through. When I last tracked the stats, when they dropped off the radar, there was about 500 firms that became authorised, 300 which were about small managers, so below the threshold, and they don't need to apply all this good stuff. 200 full managers. So I think roughly that's probably about a sort of 50-50 or 60-40 split, just in terms of full versus small. But really I think the question is, we're authorised now, what do we need to do on an ongoing basis? And how do we need to make sure that we are AIFMD compliant going forwards? So I think there are two things we've really recommended. One is, at the board level, do you have, not a checklist, but actually are the matters surrounding AIFMD monitored, reported back on often enough at the sort of AIFM level? And actually does that cover the sort of key requirements of AIFMD to make sure that the board, in their own protection, goes through the key considerations of AIFMD on an ongoing basis? And that's really going to depend on the suite of your AIFs versus non-AIFs, etc., and how big a business that is for you. And then some of the things that we recommended were, housekeeping document, which is more the operational side. So you're pushing out a level below the board around, again, some of these checklists, not only at the manager level, but also for the funds. So how are you monitoring leverage? How are you looking at this on an exception basis, etc.? And I think some of the questions, even today, that we're getting are, okay, well, I've now got a new agreement. I've got a new agreement with the depository because they're new to the table for some of these funds. I've had to amend my admin agreement. So actually, on the admin side, if there is a problem, how do I know that they're going to come back to me? Okay, well, I've got a service level agreement. But actually, do they have the right port of call into my organisation? So if there's an issue with a NAV calculation, or there's an issue with perhaps a capital calculation, and how much have I pushed to the administrator from an ongoing basis as well? So how much do they do for me versus how much do I have oversight and monitoring of? And I think the key point there really is that going into the right level of the organisation? So those are some of the questions that we're seeing out there and being asked. I think then going to the sort of distribution side, I think a couple of points which I think are going to be quite interesting to see how they pan out. So one at the moment is, in my view, seems to be a lot of US managers are sort of holding back. So they try to rush a lot of this private placement before the private placement rules changed. But really, for external managers outside of Europe, if you're private placing now, you trigger regulatory reporting into each member state that you private place. So if you are an authorised manager, you only need to report to your home regulator. But if you're going through the private placement regime, you actually have to report to a regulator in each of those member states. And not only that, you also have to apply the annual report transparency rules. So you've got a host of disclosures you need to make in the annual report. And so, for a lot of managers out there, that's actually quite a big deal from actually where we used to be from the private placement rules and the status quo if we rewind, say, a year or two ago. I think the other thing is going to be, okay, well, how much are these managers going to, increase substance in Europe and become managed in Europe and therefore access the passport in the interim? And certainly there are man codes and there are various other ways which managers out there can access. Although you still have the disclosures of the portfolio managers, etc., that you need to make on that basis. I think the question is, if you're based outside Europe, how many of them are going to access the passport when that comes in, and the ability to access that passport? Because at the moment, you've got the private placement regime, but you've got the reporting to each different member state. If you do that passport, again, you need to report to your home regulator, but then you need to comply with AIFMD. So it's a sort of cost-benefit analysis. How important is Europe for me from an investor standpoint? Or am I okay sticking in the US and accessing Asian investors? And I think the other point is, I think it's too early to tell, but certainly some conversations with my clients on the sort of investor relations side is, from an operational due diligence point of view, how much is the AIFMD going to become a point on the operational due diligence in terms of asking questions around how do you make sure you're compliant on an ongoing basis? Have you had any FCA visits around AIFMD, etc., etc.? So I think it's too early to say. We certainly have seen the question being asked around what are you doing around AIFMD, but we haven't really seen actually, now it's been implemented, how are you sure as a manager or board that you are AIFMD compliant? And I think for a lot of investors out there, it hasn't happened yet, but certainly perhaps on the institutional side, and this is a wholesale regulation, may just be, okay, I've now got extra protection, so I'd rather go for an AIFMD product compared to a non-AIFMD product, because I know there's a depository looking over the operations, looking over cash flows, looking over the custody of assets. Whereas actually, if I go somewhere else, yes, I might get custody, but I don't necessarily get the monitoring or the monitoring of the oversight of the investment strategy. I think that's important because those managers based in, say, Jersey and Guernsey, actually the question is, at some point, are they going to think about coming onshore, really to get that investor protection, either through or actually just accessing the passport and complying with AIFMD when they're allowed to from an offshore perspective. So I think that's an interesting dynamic over the next couple of years that we'll see on certainly on the distribution side. Just quickly turning on to reporting. So going to slide 12 and 13. I sort of highlighted, we've done a gap analysis on a sort of field-by-field basis, and there's roughly 30% or so which seems to be static data. We've highlighted some of the more difficult aspects here, just in terms of the reporting, the information. And I think really this depends, the complexity of the task depends on how many funds do you have, What are the investment strategies of the underlying funds? Are they closed-ended, open-ended? Are they more hedge fund-like in terms of strategy? And actually, how difficult are some of the underlying calculations? So if you look at assets under management, perhaps from a real estate perspective, that might be relatively straightforward. But if you look at it from a hedge fund perspective, where again you bring in the notionals, that could be more difficult. And actually some questions, do you do this manually, or do you push to the admin and actually then have oversight as to what they do, making sure that A, they've got all the data, and B, I've heard that some admins are trying to charge for the provision of data, even though it's your data to begin with. So if they use your data to report, they may charge you some extra. So just be careful of that in negotiations, given that you've supplied the data to begin with. But certainly in some of the gap analysis, they didn't have all the data there, so there's been some incremental, I guess, data flows from the manager to the admin house. And really the big impact's probably no surprise if you look on slide 13. Things like the risk information, so stress testing, how do you report that? That's just free text. But it's a case of what you do, and really stress testing is coming at us from a sort of liquidity of investors point of view, as well as, I guess, a bit of portfolio stress testing. And then the AUM as well as the leverage calculations. Again, really the notional value of derivatives is probably the hardest piece there. So that was a bit of a whistle-stop tour of AIFMD and what we're seeing. Hope that was helpful. But there's a lot there, so I think any of those subjects I could have spent a lot of time on, but gave you a quick taster. Have you got any questions?
Just a sort of very high-level basic question. Who's actually covered by this? So is there a test to say which asset managers, funds, whatever, would be covered by this regulation?
Yeah. So basically it's non-UCITS collective investment schemes are covered. So at a basic level, if you have seg mandates, they're out. If you have JVs, they're out. You probably want to just check the paperwork on seg mandates, because if you have an agreement which states that you can bring in other investors, you could be caught, even though practically you don't have a number of investors. The definition for collective investment scheme in this basis is ability to raise capital. You've got a number of investors, i.e. more than two, and you have a defined investment policy. So if you sort of tick those. So full AIFMD, you're caught if you manage assets in any of the member states in Europe. And even if, it's just, well, that's the basic test. So even if you have a non-European fund, but you manage the assets here, you are caught. The kicker there is that you can't access the passport if your fund's not European at the moment. So you have to private place if you market. But then we have to wait for ESMA to have a look at opening the passport to non-European funds and managers. So.
There was an emailed question earlier in the week. So, do you think the FCA will be querying where investor data for fillings stops at platforms like Hargreaves for the investor drill through, i.e. where an end investor purchases shares through Hargreaves in an AIF? A challenge is getting hold of or having resources to get and manage the data from third parties.
I think the platform's an interesting one. I think in the conversations that we've had with the FCA, I think in that situation you're basically reporting information that, so presumably you're saying the sort of platform is the AIF in that perspective. So at the fund of funds, so if you have underlying investments in CISs, you do not look through. So from a reporting perspective, you just report. So at the basic level, I guess, if you have a feeder master structure, at the feeder level, you just report the investments you have in the master. So you don't look through to the investments that the master has. So we took that example, which is quite clear in the reporting, and said, okay, well, in that example in platforms, do you look through right into the underlying investments? Or can you report the instruments that you have at that level? And I think the answer that we got so far from Olivia Fines was you report what you got there. Because I think on a look-through basis, actually, trying to get the information on a look-through basis, A, is difficult, and B, if you control, it's different. But I think on a platform, most of the positions aren't a position of control. So the assumption is that you don't look through.
Any other questions?
It's going to be a difficult one.
Switzerland's sort of AIFMD policy.
Well, yeah, so Switzerland isn't dissimilar from some of the Channel Islands. The Swiss are trying to bring in an equivalent regulation, and they have done. So they've brought an equivalent regulation similar to AIFMD. And the thinking there is that when you open up the passporting regime, either later, end of next year or later next year, that they will be an equivalent regime and they can access the passport to European investors. I think Jersey and Guernsey are taking a similar view. So both Jersey and Guernsey have also had a lot of dialogue with ESMA around how they would be viewed in an equivalent regime to AIFMD. So at the moment, Switzerland's taken that view at the moment, but because it's not part of Europe, before we get that passport from a marketing perspective, they have to private place.
So do you think Switzerland will use their passporting regime as well?
Switzerland's trying to get them into their position whereby they have got the equivalent regulation to AIFMD on a local and national level. And one of the conditions, we think, we don't have a discussion paper out at the moment, but places like Switzerland, Jersey, Guernsey have had conversations with ESMA. And if they get themselves to an equivalent position, the thinking is that they can then access the passport for European investors when non-European managers and funds are allowed to access the passport to European investors.
Okay, everything?
Sorry, I have a question. Is it for new marketing to new investors, or if you have existing investors and you are covered under the regulation?
So there are grandfathering provisions there, which were basically, are you fully invested, and had you sort of previously marketed the funds and you got liquidation dates, etc. around it. So you really want to go through those grandfathering provisions first, but really it's from a managing perspective, if you don't meet those grandfathering provisions and you tick the criteria from a scoping perspective around collective investment schemes and you manage in Europe, you're in. If you market, you've got existing investors, you're an open-ended fund, you want to tap Europe again, you're in. From a marketing perspective, from a private placement regime perspective.
Okay, if you're closed at the moment, but
Yeah.
you are based in Europe and you have European investors, are you?
So if you, I think it was,
Report?
do you need to report?
I mean, are you regulated?
So if you, I think the basic test is, are you going to liquidate your fund sort of pre-July 2016? And were you fully invested coming into AIFMD? So there was a clause, there are two tests. One is, are you fully invested? I think it was back in when the legislation came in, which was in 2011. And the other one was, have you deployed your investments? So one was, have you marketed fully? Boom. And then once you've marketed, have you fully deployed, invested that amount, the capital exactly, post-July 2013? And was your fund going to liquidate pre-July 2016? So if you meet those, you're out. If you don't, you manage assets in Europe, then you're in.
Quick question. One of the things I've heard is that countries like Germany and maybe Austria to follow adopting a policy of UCITS being the sole product that was sold. Do you think that other countries will follow, and that would mean that organisations with AIFMDs outside the EU won't be passported into those countries? There'll be less AIFMD reporting over time.
It's a bit of a crystal balls, isn't it, that one? I heard that as well. And it's interesting in some ways, because you look at the regulations, AIFMD's leapfrogged UCITS. And I think, certainly and we've been talking to some Asian managers, and actually they've had a similar view. Actually, it's better to go into the UCITS world rather than have a hybrid between, we've got product in UCITS and AIFMD. I can't answer, I think time will tell, but certainly my conversations are a bit of a mixed bag at the moment. So some Asian managers, for example, are quite happy to have a bit of a mix. But some are actually looking at, so if you take it, some of the hedge funds, for example, I spoke to who might be looking to market in Europe, they were looking more to go through the UCITS wrapper, even though you've got the restrictions in UCITS, because they think from a global perspective, the UCITS brand has got a bigger name. And actually, from an investor protection point of view, you've got UCITS 5 and UCITS 6 coming in anyway, so that's going to make it equivalent to AIFMD. So why should I have two regimes when actually I can wait and just use the UCITS regime to market? I don't know the answer to that, but sort of the thinking seems to be slightly mixed at the moment.
That's another one that I think it's a bit hard to answer as well, potentially, but we have funds that overlap between AIFMD, MiFID, and where they fall into the category we have to follow all those different reportings.
Yeah.
Do you think that the regulators will be comparing results between those different funds?
So the conversations basically the FCA is building this regulatory tool where they can slice and dice data, you probably know. And there was talk about, not necessarily related to that one, but a gateway with the SEC. So even though the overlap between Form PF and AIFMD is only about 40%, they wanted a gateway where it did overlap to compare the two data sets. I think the next step beyond that is then to aggregate all the data they get from EMEA, MiFID, MiFID 2 in 3 years' time, as well as AIFMD and UCITS, and then start comparing that. ESMA is clearly worried about systemic risk, and that's why we've got so much reporting on AIFMD, especially around leverage, liquidity, etc. So I think they would use the data of all the underlying products that they could in order to come to some of the, I guess, supervisory type conclusions that they want to come to from a risk perspective. Again, difficult to answer because I've sort of taken snippets of conversations. One was Olivia Fines of the FCA, who's now moving. But I think some of it's partly a vision as opposed to where they've got to. I think it's going to be a good 5 years before they get to that. They're short resource, and they built a great tool around AIFMD, but that's one component of quite a big market.
We're done. Lovely. Thank you very much.
Good.